It almost never makes sense to invest in an IPO as a retail investor. There, I said it. It might sound harsh, but if you take away the excitement, the hype, the shiny social media ads, and just look at the numbers, you'll see what I mean. Most IPOs today are not designed to make you money, they are designed to help someone else exit. Let's unpack that. See, the idea of an IPO, an initial public offering, sounds great on paper. A private company becomes public, and for the first time, regular investors like you and me get a chance to buy in. That is how it should work. But in reality, IPOs have become exit routes for early investors and not entry points for retail wealth creation. Most of the recent IPOs are structured almost entirely as offers for sale. That means the money you're putting in is not going to the company for growth or expansion. It is going to existing shareholders like private equity funds, early VCs, and even promoters who are cashing out. You're not funding the business, you're buying their shares so they can walk away with the profit. And they're not doing you any favors with the pricing either. Take a look at the valuations. Companies are coming to market at sky high PE multiples, often 60, 70, even 100 times of earnings. That is not a value opportunity. That's a fully loaded price with zero margin for error. By the time this IPO hits the market, the cake is already baked and the icing has been scraped off. But what is worse is that these IPOs still get massively oversubscribed. Why? Because everyone has got IPO FOMO. Your favorite influencer is talking about it, your broker app is buzzing with notification, your friend applied and got a 20% listing pop at the last time. And suddenly it feels like you're the only one not applying. So the logic becomes, it is only 15,000 rupees, what is the harm in trying? Let me tell you what the harm is. You are being sold the idea that IPO investing is some kind of fantasy league, just like Dream 11 or IPL betting. The way discount brokers are advertising IPOs today, you would think that it's a game. There is a countdown clock, confetti, and congratulations screen if your application is successful. But here's the thing, markets are not casinos, and IPOs are not scratch cards. Frankly, a 20% pop on 15,000 investments is not taking you anywhere. This was not always the case. There was a time when IPOs genuinely allowed investors to build wealth. Think Infosys, HDFC, Reliance, etc. These companies came to market early at reasonable valuations and grew steadily over decades. But those days are gone. Now more serious valuation discovery happens before the IPO, in the private markets. Companies raise money through angel round, Series A, Series B, Series C and so on, pre-IPO placements and then finally open the door to the public. By then, early investors are ready to exit and they're not offering you a bargain, they're offering you an exit opportunity for them. So let's talk about some names. LIC, the biggest IPO in Indian history, came with huge marketing, patriotic emotion, and massive institutional support. Retail investors piled in, but what happened? It listed at a discount and took months just to get back near its issue price. Insurance companies are notoriously hard to evaluate, but people were betting nevertheless. Zomato, another hyped up IPO. Sure, it had first mover advantage in a new market, but it came at a very frothy valuation. It listed at a pop, but then tumbled more than 40% from top. Paytm, the poster child of overpricing. A 2,150 rupee issue price opened with a thud and collapsed 70% in the following months. It has recovered a little now, but ask anyone who applied, would they do it again? Car Trade, listed in 2021. All offer for sale, no fresh issue. Promoters and private equity players exited. It was priced around 1600 and today it trades at around half of that price. So what do we have in common here? Overpricing, massive retail participation, and painful drawdowns for those who were caught in the hype. The irony is, we are living in a time when access to markets has never been easier. Thanks to platforms like Zerodha and Grow, opening a Demat account is as easy as ordering food online. You can apply for an IPO in 2 taps, but here's the catch. While access has gone up, awareness has not. Most people applying to IPOs don't even know what the company does. They have not read the prospectus, they don't understand the business model, the risks, or the valuation. All they know is number goes up. And if it goes down, well, maybe try again next time. That is not investing. That is blind optimism. Even the few documents that are available, like the DRHP or the draft red herring prospectus, are long, complex, and unreadable for most people. They're filled with disclaimers and risk factors that no one talks about. You will never find a reel explaining the company's receivables turnover ratio, but you will find someone shouting, apply now, GMP is 150 rupees. Here's something else that you might not know. Mutual funds also apply for these IPOs. Your SIP money, meant for long-term investing, sometimes gets used to chase short-term gains. Fund managers under pressure to show quarterly performance apply for overpriced IPOs just to stay in the game. But when they do that, they give retail investors a false sense of security, as if the IPO is safe because big money is applying also. That is not always true. Institutions can exit quietly, but you cannot. Now, let's be clear, I'm not saying that every IPO is bad. Once in a while, there is a good business at a fair price, maybe even a bargain, but those are very rare. And spotting them requires real work, reading, analysis, and valuation, not scrolling through Twitter for GMP updates. That is why I'm a big believer in financial awareness. Not stock tips, not hot picks, just basic, grounded understanding of what you're buying and why. And that is also why SEBI has created professional licenses like RIAs and RAs to build a network of people who are accountable, trained, and regulated to give you financial advice. But if you ever feel like you want to understand markets more deeply, not just IPOs but how to evaluate any company, it is worth learning the frameworks that professionals use. Most people don't need a demat account. They need a better filter, a lens to tell hype from substance. Because once you start asking the right questions, where is my money going, who's selling to me, what is the business model, and so on, you'll start spotting the patterns. You'll realize most IPOs are not opportunities. They are exits dressed up as opportunities. So the next time someone sends you a screenshot of their IPO gain, ask them if they've held it for a year. Ask them what the company actually does. Ask them how much of the IPO was offered for sale, and ask them what the PE multiple was. Chances are they don't know. And once you know, you will not fall for it either. If this video helped you think differently about IPOs, give it a like, leave a comment, and share it with someone who think that applying to IPO is going to make them very rich. And if you want to go deeper, understand how to read DRHPs, evaluate businesses, or even explore a career in research or advice, our Telegram group is a good place to start. It is free, and we try to keep the conversations grounded, practical, and hype-free. Thanks for watching, stay sharp, and remember, just because everyone is applying does not mean that you should too.